Last year, 8 homes in San Francisco sold for at least $1 million over the asking price. This year, that number is 144. Not million-dollar homes, $1 million over asking. One house listed at just under $8 million. It sold for 15. And here is the strange part. The two companies most responsible have not gone public yet. OpenAI and Anthropic are still private, but their wealth is already loose in the city. One seller on No Street will even take pre-IPO stock instead of cash. In San Francisco right now, a share in a chatbot company is a kind of money. Meanwhile, engineers on 6-figure salaries are being told, politely, that they can no longer afford to stay. Two things are happening at once. A fortune is arriving, and a city is splitting in half. You're listening to the Veritas Brief. We're the podcast from Veritas Europea, a reader-funded newsroom. We follow the money, through Europe and wherever it runs. Today, it runs up a hill in San Francisco, because this is not only an American story. 3 of the biggest listings in history are lining up at once. Together, they could move more than $100 billion in a single window. Analysts warn that much capital could ripple through markets everywhere. So these bidding wars are a signal for all of us. Let's get into it. Start with the 2 names at the center. OpenAI makes ChatGPT. Anthropic makes Claude. Both are headquartered in San Francisco. Both filed confidentially for a public offering this summer. Anthropic filed first, on the 1st of June. OpenAI followed within days. Each is chasing a valuation near $1 trillion. For scale, Anthropic's last private round valued at around $965 billion. OpenAI's sat near $852 billion. Something remarkable happened there. For the first time, Anthropic overtook OpenAI in value. The underdog pulled ahead of the giant. Its revenue has grown at a pace no software company has matched. The run rate jumped from around $9 billion to over $40 in half a year. Anthropic even expects its first profitable quarter, though the company warns that profit may not last. OpenAI, for its part, is still losing enormous sums. Both are betting that scale today buys dominance tomorrow. And a third giant joined the race. Elon Musk's SpaceX went public in June. $3 trillion listings all in one narrow window. Nothing like it has happened before. Now look at what all that paper is doing to the city. Redfin says San Francisco has the fastest rising home prices in the country. The median sale price rose about 16% over the year to May. The median price per square foot crossed $1,194. That figure jumped more than $200 in 9 months. At the top of the market, the numbers turned surreal. The median luxury home now sells for nearly $7 million. Those homes go under contract in about 12 days. A year ago, it took nearly a month. Compass counted the bidding wars directly. 144 homes sold at least $1 million over asking in the first half of this year. The year before, only 8 did. In June alone, there were 44. Some sales defy belief. A home in Cow Hollow listed just under $8 million. It closed at 15. A house in Presidio Heights listed near $4 million. It sold for over 8. These are not outliers anymore. They are the pattern. To understand this, you have to understand the city itself. San Francisco has always run on sudden fortunes. Its grand mansions rose on mining money and railroad money. Then software barons replaced the railroad barons. Now the AI founders are replacing them. Ted Egan is the city's chief economist. He has watched booms come and go for 20 years. He told Marketplace he has seen, quote, nothing on this scale. And he made a sharper point, too. The money this time dwarfs every earlier tech wave. But it flows to a very concentrated group. The rest of the industry is shrinking, even as the winners soar. This is a gold rush, but only a few are striking gold. So here's the puzzle we set out to solve. 2 companies going public should not move housing today. The shares aren't trading, the cash isn't out. And yet the market is already on fire. The answer is that the wealth does not wait for the IPO. Employees and early investors hold huge equity right now. And they can sell some of it early. The Wall Street Journal reported one striking example. Last October, more than 600 current and former OpenAI staff sold shares. The total came to $6.6 billion. About 75 of them hit a $30 million cap. That money does not sit in a bank. It buys homes. Tender offers and secondary markets unlock this cash before any bell rings. Some of that secondary trading is not even fully legitimate, but the effect is real either way. Researchers at Rice University's business school studied this pattern. They found that IPO liquidity can reshape a local economy. San Francisco is living proof of that finding right now. The process is simple, and it is brutal. First, a payday turns locked-up stock into spendable cash. Second, that cash lands with a small group of high earners. Third, they all chase the same tiny supply of homes. San Francisco barely builds anything new. Its geography and its rules keep supply painfully tight. So new demand hits a wall. Prices spike, bidding wars follow, and much of it happens out of public view. One advisor says about 70% of his deals never hit a public listing. He calls it a mansion deficit. The best homes trade quietly, before anyone else even sees them. He told Marketplace these are simply unprecedented times. The access to wealth, he said, has no recent parallel. And remember, this is all before the main event. This is the part most people miss. The anticipation has already pushed prices up, but the biggest wave is still ahead. Here is why. Most employees cannot sell right away. IPOs come with lockup periods. These rules block insiders from selling for a set stretch. Most last around 6 months. When they lift, the real selling begins. Studies of past IPOs found the buying surge comes later. It tends to peak 6 to 9 months after the debut. So if these firms list this autumn, that window opens in 2027. What we are watching now is only the preview. The main feature has not even started. Quick pause, and we'll be straight with you. This is the only ad you will hear on the show, because we don't sell them. Veritas Europaea takes no advertising money, none. No hedge fund backs us. No billionaire owns us. The people who listen to this fund it. That independence is the entire point. It is why we can follow the money without flinching. So if this reporting is worth something to you, back it. Membership is €2 a month. That is less than a coffee for a newsroom that answers to you. Go to veritaseuropaea.eu and join us. €2. It keeps us free in every sense of the word. Right, so the biggest wave is still ahead. But it is not landing on an empty city. It is landing on a very specific set of streets. Let's map them. The wealth does not spread evenly. It pools in a handful of neighborhoods. Compass found Noe Valley led the city in these million-over sales. Its closeness to the peninsula draws Silicon Valley buyers. Pacific Heights and Presidio Heights saw the most dramatic overbids. These are the old money enclaves, now flooded with new money. And here's what makes this boom unusual. The Wall Street Journal found the surrounding counties are not seeing the same heat. In past cycles, the wealthy spread out to the suburbs. This time, they are moving back into the city. AI firms prize density and in-person work. Their staff want to live close to the new power centers. For years, people said San Francisco was dead. Empty offices, tech layoffs, a hollowed-out downtown. That story just got rewritten in real time. But not everyone is riding this wave. The market has split into two speeds. At the top, cash buyers move fast and pay anything. Below them, ordinary buyers are stuck. Mortgage rates sit near 6.5%. For most families, that makes the math impossible. Chen Zhao, an economist at Redfin, put it plainly. High-income buyers are driving demand and prices. But first-time and average buyers are simply priced out. The gap shows up in the raw numbers. San Francisco is the only major market west of the Mississippi with more buyers than sellers. In May, buyers outnumbered sellers by 14%. In Oakland, sellers outnumbered buyers by 30%. In Los Angeles, by 56%. San Francisco stands almost alone in its intensity. We should be fair to the skeptics. Not everyone blames the IPOs. Mike Simonson is the chief economist at Compass. He built that over-asking report himself. He told The Real Deal, quote, "I haven't seen anything like this." But he doubts the listings are the real driver. His point? Most tech wealth comes from companies already public. He points to NVIDIA, which listed 27 years ago. Its recent surge added trillions in value. When markets hit records, workers at Meta, Google, and Apple cash in too. In his view, the broad boom matters more than any single debut. Daryl Fairweather, also at Redfin, adds a structural point. She doubts one listing would move the market overnight. But she sees a lasting imbalance underneath. Strong demand meets a permanent shortage of homes. The bidding wars ease only when inventory grows or demand cools. She expects neither anytime soon. We think both forces are at work, and they feed each other. For a reality check, look north to Seattle. Seattle is a tech town too, but its story is the opposite. More than 11,000 tech workers there have lost jobs since May of last year. Companies cut roles as AI reshaped their teams. Seattle's luxury market has cooled sharply. A new state wealth tax is pushing some rich homeowners to sell and leave. So the tech economy is not one single thing. In one city, it mints millionaires. In another, it cuts jobs. San Francisco is the outlier, not the rule. That is worth remembering before anyone calls this a national boom. And there is a real cost to all of this. A high salary no longer buys you in. The New York Times profiled a couple hunting for a home. They toured 30 listings in 3 months. At one apartment, 30 people signed up to apply within an hour. They gave up the search. One of them, aged 27, said they could not see a way to stay. Another worker earns enough to sit in the top fifth of American households. He still felt, in his words, not good enough to live there. Because he does not work at an AI company. A phrase is now going around tech circles. People call it the permanent underclass. It is the fear that missing this wave means missing the last one that counts. Didi Das is a partner at Menlo Ventures. Overnight, he said, some of his friends became worth billions. Even they don't quite know how to process it. And his other friends, who did everything right, now feel left behind. One agent summed up the mood bluntly. He relayed what an AI client had told him. Quote, "Even if these people's stocks drop by half, they are still rich. Now, the market could still turn. This summer has already been rocky." SpaceX went public on the 12th of June. It raised more than $85 billion. Its valuation briefly topped $2.7 trillion. For a moment, Musk was worth well over $1 trillion himself. Then the stock fell hard within weeks. Musk lost his trillionaire status almost as fast as he gained it. That reception spooked the other candidates. Reuters reported that OpenAI is now weighing a delay to 2027. And the risks are not only about market mood. Anthropic is locked in a fight with the U.S. government. The Pentagon labeled it a supply chain risk. The company says that could threaten billions in revenue. OpenAI, meanwhile, is still burning cash at an astonishing rate. A weak debut would soften the whole wealth effect. A correction could shrink these paper fortunes overnight. So nothing here is guaranteed. One veteran agent captured the fatalism perfectly. Jeremy Rushton has sold San Francisco homes for 14 years. He warned that logic rarely prevails in this market. Confidence and fear, he said, take turns at the wheel. For now, confidence is winning. But that can change. So what do you actually do with all this? If you are a buyer, you face a hard choice. Many are racing to buy before the IPOs price in more wealth. Agents describe open house crowds voicing that exact fear. People walk in and say they wish it were 6 months ago. That front-running behavior lifts prices on its own. In a thin market, expectations become self-fulfilling. If you are a seller, you hold rare leverage right now. Some sellers will even take stock instead of cash. If you are a renter, the pressure is only building. And if you are watching from Europe, watch the capital markets. These listings will test how much appetite investors really have. The result will echo far beyond one American city. So where does this leave us? Our read is this. The IPOs will not flip a switch on day one. The wealth effect is slow, and it has already started. Anticipation lifted prices all through 2026. Early stock sales turned paper into cash. The listings, if they hold, will pour on more fuel. The biggest surge likely waits for 2027 when the lockups lift. New supply will not save affordability in that window. Demand is not cooling. The skeptics are right that broad markets matter too. But in San Francisco, the two forces amplify each other. The liquidity wave is building. The only real question is how high it breaks. That's the Veritas Brief for this week. We built this episode on public filings and named market data. Every source sits in the companion piece at veritaseuropea.eu. If it made you think, send it to one person who should hear it. And if you haven't yet, €2 a month keeps this newsroom independent. We'll follow the money again next week. Until then, stay sharp.